Good afternoon. Welcome to today's stream. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those four, we'll take a quick look at the U.S. dollar. We'll look at oil, gold, and silver, and then we'll move on to chart requests. Anyone in here or anyone that's watching a video of this, if you have a chart request, those of you that are in here could feel free to type it into the chat tab, and we'll get when we get a chance towards the second half of this, we'll go ahead and take a look at them. If you're watching this as a recording, you can always message me at StockDarts on Twitter. I'll be more than happy to give you any chart requests you have on there, or any questions you have, whether it's on this video or just the general markets. It's always nice to interact with people. So you follow me on Twitter. You can always ask me questions there, and I'll be more than happy to help out. You can also see copies of these videos as well as other videos if I post them on YouTube at the name StockDarts. And you can also visit patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list stuff, and sometimes even like this Monday it was more a blog post about how I approach trading and how I go ahead and divvy up my trades between long-term, short-term, and intermediate. And just, so basically just it's a space where I go ahead and talk about how I trade and how I approach the markets. And what we do is normally on these Wednesdays, we try to analyze what kind of market environment we're in, and then try to tailor our trades based off of that. And the type of trade ideas and generally speaking, the way I approach the market, I'm going to go ahead and put it on there on that StockDarts blog at patreon.com. And that's where I typically expand on whatever we do during these Wednesday streams on Twitch. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500, and we're going to do it through the ETF SPY. And we're having a nice week so far. As you can see, we've got 3 days of green action. We haven't really gone anywhere since the open of the week, but overall, when you compare where we were from last week, we're doing pretty good. Last week we opened very strong. Now, this is kind of important. Last week's open and where we stand right now, and the reason for it, because last Monday we had a market gap up significantly higher on weekend news about a vaccine being close to being ready to be deployed. Pfizer had reported really good results and something like 90% success rate. Moderna has their own vaccine that's also doing well, and so the market gap significantly higher on the positive momentum and just people getting excited about maybe moving back towards a more normal economy where people can actually go out and shop and not have to wear masks everywhere and actually attend things like movies and cruises and travel and all that kind of good stuff. Now, we faded the entire day, right? So I think it was a little bit maybe, we got a little bit ahead of ourselves as far as expecting a quicker recovery than what was really going to happen based off of the news that we got. But the market found support. And as always, the market is forward-looking, and it's always looking for the next step. And we found support over the next few days, and then this week we've started to come right back up and start to challenge that level that we gapped to and those highs that we formed, which in some cases were all-time highs, right? If you take a look at the S&P 500 and you see where we are compared to where we were back here when we printed new highs and compared to the new highs we printed earlier in the year, we'll go to a weekly chart real quick to show that. You'll see that we are actually still trading very, very near all-time highs. So overall, the market is still pretty confident that we're ready to move forward. And again, if you take a look at what's gone on in the last, 7, 8, 9 years, we've had a market that's just gone straight up for the most part. And we've had some moments of consolidation, and this is not something small. These are nice 2-3 year patterns of range-based trading. And then if you really just discount this swift drop that we had because of the coronavirus, we've actually kind of made our way right back up to where we were before and started to try to challenge those highs again. Are we ready to continue climbing upwards? I don't know. I think the climb that we had here was pretty impressive, but just to give you a better picture of what the big picture looks like, we're in a very strong market. And despite the fact that in the short term, or maybe if you just take a look at the year as a whole, or if you just try to remember where the economy is, you might think that the market's not as healthy as it is. But the truth is, whether our economy is healthy or not, the market is. And the market is again, forward-thinking and expecting better results. And I think the big thing we could take away from this is over the last 2 or 3 weeks, we've had a shift in where money is rotating to and what kind of stocks are doing well. And this is something we discussed a couple of weeks ago. And actually something we've been discussing for the last month and a half, and that is there's been a little bit of a rotation, and you can see it to a small extent here on today's percentages. You can see IWM is outperforming at 0.47. The Dow is up 0.14, the Qs are up 0.36, and the SPY is up 0.15. So we're getting a little bit more outperformance out of IWM in the small caps, and this is not an aberration. This is something that we've been seeing pretty consistently over the last couple of weeks and over the last basically month and a half now. And it's showing that money is rotating into some of these names that we've had less confidence in throughout the year. And we'll get into that in a little bit more detail as we move forward and we go through all the indices. But what I'm seeing here is the trade that we've been focusing on all year. And for those of you that maybe are new, I'm pretty sure most of the viewers here are regular viewers that come all the time. But our focus all year has been on stocks that there's been a big sort of divide between stocks that benefit from us working and shopping and just basically doing all our consuming from home, and the stocks have been punished from our populace being kind of stuck in quarantine at home, right? So stuff like Amazon, Netflix, Zoom, those kind of stocks, Peloton, like any of the stocks that really benefit from people staying home, have done really well all year and continue to do well. And I think we'll continue to do well even as we move forward into the next couple years, even once we've recovered and people are allowed to go back out in the streets, because that was a pattern that was already developing in our society already for the last several years. We've had a big shift in more and more of our commerce and more of our work being shifted to computers and being shifted to working online. And so I don't think that's something that's going to go away. However, for this year there has been a big shift in the trading where most of the capital has kind of stayed in that little circle of stocks, and other names like if you look at the other names that have been punished, stuff like airlines, movie theaters, restaurants, casinos, a lot of the more industrial type names that actually require people to go out and consume, travel and consume energy and, just generally move outdoors and stay off, not be online. Those names have been hurt. And those names haven't really fully recovered, and most of those names are still kind of in the process of kind of stabilizing and making their way up. And what we've seen now, as we've gotten closer and closer to a potential vaccine and a possible return of our workforce back out into the wilds, is those names have started to recover. And some of the names that have benefited all year have started to stall out and not necessarily drop, or at least not drop significantly, but started to consolidate a little bit more as money rotates out of those and into some of these more beat up names that have really struggled. Another one, real estate and the commercial real estate like the malls and stuff. They've all kind of started to pick up a little bit of steam, and we'll look at them a little bit more in detail as we move forward and we reach the section after the markets where we start looking at chart requests. But the pattern here has shifted, and the question now as we trade is this something that we consider to be a 1 or 2 week aberration, or is this something that we could kind of rely on as we move forward into the rest of the year and into the start of next year? And I think as we have seen here, I think it's starting to reach a point where we can start to shift our focus and not just kind of trade the basket of tech stocks and actually start looking at trading other names. However, I'm not 100% confident that I'm ready to really go out and trade some of the more beat up names. And like I said, we'll talk about that in a little bit more detail later. But first, let's just look at the market as an aggregate. And the S&P 500 I think is the best chart as far as representing the market as a whole. And as you can see, what we're doing right now is, like I said, still positive. Last 3 days, we're kind of consolidating just below all-time highs, trying to set up for a move above it. You can see we actually have a nice little trend going overall, right? This is all okay. All right, we don't need to put that trend line there. All right, so as you can see, we've got upward momentum, right? After we bottomed out, we've just been kind of coming up and challenging, and we kind of have a little triangle forming here. And so now the next step is, are we going to have enough momentum to push through this triangle and up into new all-time highs? And I think that's going to be the question that is going to be addressed next week as far as the market price action is concerned is, are we going to move forward and start to move past this range? And you can see we've actually been range bound. We've been range bound for 3 months now, 3 or 4 months, right? If you really come back and take a look, since the middle of August, we've basically been trading in a range, and we are now starting to break outside of that range. And so everything is really moving according to a normal technical analysis and normal technical behavior. We're not seeing anything out of the ordinary here. We're seeing a move. We printed new all-time highs. We were not really ready to sustain that level, so we came back and we pulled all the way back to figure out where value is, where buyers are willing to step up and support the market. We found that. We came up and we tested resistance again, failed a little bit short of that, came back, tested support, and actually found support a little bit ahead of that, right? So we're having the normal exchange going back and forth between buyers and sellers as we build up momentum to try to move forward in the markets. And what we're doing right now is we're breaking outside of our previous range, and we're trying to find enough momentum and enough buyers that decide, well, you know what, this is no longer overpriced, and we think that this is a good deal, and that's what pushes the market upwards and beyond the previous range. And so this is actually positive, particularly when you look at it from a seasonal nature and you realize we're getting really close to Thanksgiving, we're getting close to the holidays, which typically are a time in the market where we do get a decent amount of positive price action, and there's a decent chance that, again, we rally into the holidays and move forward here. So overall, I like what I'm seeing here. Now, if we want to try to figure out what is the first sign that we're not ready to move forward, and that's going to be a break of this ascending trend and also a break of the previous highs. So if we start to make our way back below, I'd say about the 357 to about 355 range, and start to head back into these low 350s, I think that's the first signal that maybe we're not ready to break out. However, to truly have a breakdown here, we'd have to get below the moving averages and get below this 342. So I think this is the critical level here, right around 342, as far as deciding whether the market is not ready to rally and is going to be more range bound, or possibly even head back down and test the lower ranges around the 320 range. So that to me is the key level. Now this is an important level. This is exactly where the market started to fluctuate way back in the beginning of September, and has been a kind of an important price point to deal with throughout the last couple of months as we've stayed range bound. And so as far as the floor, or the line in the sand that we need to worry about, I think that's the level. If we lose that level, there's a very good chance we head all the way back down to 320s, and maybe even come all the way down and wait to test the 200 period as it comes up to meet price. So that is kind of our key point. Now, obviously, upside, all we have is this here about 3 points away, which is recent highs. And if we push past that, well then, you know, the sky's kind of the limit, really. There's no more resistance up there, as this is the highest point that's ever been traded on the S&P 500. So those are the two primary levels that I'm concerned with right now, is 364 and about 343. However, in the short term, like I said, there should be some support. If we end up breaking this ascending trend line, which is not that significant or not that strong, we should find support somewhere in the low 350s. And as long as we find support in the 350s and we stay above our moving averages, then we are likely going to come up and retest and break through those recent highs, and at least marginally try to print new highs as we head into the end of November. So that's kind of the game plan as far as what's going to happen here between now and next week, or the next couple of weeks, as we head into the holidays, is the market should stay stuck in, or should stay somewhere in this short-term range. I don't expect it to head down too much further south than that, and if it does, you know, our first warning signal will be a break of those moving averages, and I think at that point that's when we have to worry about changing our approach to the market. But until then, I'm in a bullish stance, and I think that, again, we've had a really nice change here in market character since the beginning of November. And so at this point, even if we have sell-off candles, I think that we're still looking at buying the dip, and I think that we're looking at playing momentum to the upside as we continue to consolidate and move forward off of this big shift in character. And again, the big shift happened here right at the start of November, as we kind of bounced heading into the election. We actually bounced prior to what the election results were, and really started to kind of rally up even through the mess of trying to decide who's going to win, or Trump not admitting defeat. Um, Through it all, the market just kind of persisted upwards, and I think that's a nice change that shows that the buyers are in control again. And until we see a big shift back down, we have to go under the assumption that the buyers are in control, which means we're going to continue to press our ceiling and press towards new highs. And so that's really the idea now is, are we going to come back and retest this 350 before we move forward, or are we going to break above it? And we've got our trend lines that are going to tell us. And so I think it's really simple. For those that maybe trade along the same lines as I do, well, our trend lines will tell us what to do next, right? We're going to wait for a break to the upside of 364. If we lose this trend line, the short-term ascending trend line, well, then we wait for the low 350s before we make our next play. And if we lose that, then we wait for 343 to make our next play. All right, now, if we take a look at the NASDAQ, we're going to see a similar picture. But you'll see, relatively speaking, how these tech names are starting to behave a little bit worse. You'll notice not only do we not clear the highs from last week, or come close to them, we didn't clear all-time highs that we printed back in September. So the tech names and the Qs, remember the Qs are very heavily weighted in the FANG stocks of Facebook, Amazon, Apple, Netflix, Google. And they've been kind of, I don't want to say they've been performing poorly, but they've been stalling out. And a lot of that, again, is because money is rotating towards other areas that traders are expecting a more strong recovery, as opposed to these names which don't have to recover because they're all already trading at highs. And so what we're seeing here is, again, a rotation of capital, which is important for us as traders to really understand. Because, again, you don't want to just blindly trade the same names over and over if they're not going to give you an edge or give you an advantage. You want to make sure that you're on top of the pulse of the market, and keeping track of where money's rotating in and out of, in order to get the quickest return you can on your trades, so you can turn around and go ahead and deploy your capital somewhere else. Sometimes it's easy to get kind of complacent or a little bit lazy and just follow the same 5, 6, 7 stocks that you want to trade. And what ends up happening is you might end up having a successful trade, but you parked money in it for a month and a half when you could have had maybe 2 or 3 successful swing trades with that same money in the same amount of time, by making sure that you're paying attention to what's actually getting strength and what's losing strength at the right times. And so in this particular case, as you can see, the NASDAQ, with respect and with relative comparison to the S&P 500, is stalling out. Again, look at where the all-time highs are. Look at where we are now. Is this a weak chart? Is this a chart that's ready to break down? No, not at all. Just when you compare it to its peers, it's struggling a bit. Will money rotate back into these names at some point soon? Probably. And that's that's our job as traders, is to understand when it's going to pick up steam and kind of play some catch up. And not sure it's ready to do that yet, but that's something we'll pay attention to. So as far as the levels we want to look at, this is kind of the key ceiling in the short term. And here's the floor. You can see we're actually not that far away from it, but it's the same general idea. If we lose this level around 284, if we lose the 20 and the 50 per moving average, we're probably heading all the way back down into the 268 to 265 range, and that would be not a good look for the markets as we head into the holidays. But in the bigger scheme of things, like I've pointed out in the weekly chart of the S&P 500, in the bigger scheme of things, even if we falter here and we head back down, we're still in a pretty strong market. We're still in a bull market, and there is more support coming up. It's not like if we lose these moving averages, we're heading all the way south and topping out and heading into a bear market or anything alarming like that. It would just mean that the market's going to stay range bound and trade in that range. And again, you can see the range pretty clearly as well on the Qs, and you can see we're just stuck in a range here. So unlike the S&P 500 that's already trying to break out of that range, the NASDAQ is still just going back and forth, trading between about the low 260s to the low 300s as far as the trading range it wants to trade in. And I think if you take a look at the big picture, it keeps you from getting into trouble and from jumping to conclusions when you see a big red candle. I'm not sure if Fat Boys, if you're in here today, but I remember you were asking me earlier in the week. You were wondering if or I don't remember if it was early this week or last week. You were worried about the big some red candles and wondering if we were heading lower. And I told you just give it some time. That really it's just that we gapped up higher than we were ready to gap up. And as you can see, the buyers have kind of come back in and have pushed the market back up a bit. And we're not really in a market that people need to panic about yet. We're just in a range-bound market that's going back and forth. There's going to be, and just to kind of give you an analogy, think about it like, I live here in South Florida, and I get to do stuff like kayaking and going out boating and stuff like that all the time. And what you'll notice sometimes is when you have two currents that meet, say I'm out in the Everglades and we're in kind of a little channel, and it comes out and meets with another channel or with the ocean. When you have these two currents that meet together, you get really brackish or muddy water because you have the two currents kind of conflicting, and you get a bunch of choppy, waves and stuff like that. And that's what's happening here in the market, right? You have bulls that want the market to go up, and you have buyers, bulls, whatever, demand, however you want to define it, that is supporting price action going up. And then you have this resistance, you have this wall of sellers, this wall of distribution, potential distribution, that is thinking the opposite, right? And so what happens is when you're in a range like we've been in, you're going to get back and forth because you're going to have the two currents coming together and colliding. And so what happens, you get muddy water, right? You get this brackish area where you don't have a very clear picture of what's going on. And that's what we're seeing right now, and that's why we have this back and forth, and that's why you don't want to get too caught up in what you see from one day to the next, because one candle might look really negative, and then just a couple days later, you'll get a good candle because the buyers step up that day, and all of a sudden things look a lot better. So you're going to have this going back and forth, until we have a clean current, and you have more buyers than sellers that want to go ahead and push the market through. And so we're not seeing that on the NASDAQ yet. As you can see, the NASDAQ is clearly range bound and not ready to move forward, although we're starting to see the waters clear up a bit on the S&P 500. And as you'll see in a second, we'll get to that when we get to IWM, the waters seem to be clearing up there as well. However, over here we're still in a little bit of a muddy picture, and we're going to need to see, in particular, some of these FANG stocks get a little bit stronger before we're ready to get a cleaner picture on the NASDAQ. But overall, like I said, whenever you're not sure, just drag your slider back on your chart and take a look at the bigger picture. And that should give you a better idea of what we're doing and whether these short-term fluctuations are more serious or more important than they really are. And I think at this time, if you really just step back and look, the short-term fluctuation doesn't mean much right now. And so as far as I'm concerned, my overall view of the market hasn't changed because this big picture hasn't changed. And until we see that picture change, I'm not going to go ahead and change my point and change my viewpoint on the market. So we're still in a strong bull market. We're range bound in the intermediate term or in the short term, and it's just a question of when we're ready to push past that range or whether we're going to keep trading sideways. And like I said, the Qs right now are trading sideways while we're seeing the S&P 500 inch a little bit upwards. So that gives you a better idea of what you want to look for as far as stocks that are going to be behaving well in the short term. Now, as far as key levels to look at, like I said before, 284 is critical. If we lose 284, if we lose the moving averages, we're going to head down to this newly developing trend line here. And as you can see, there's going to be some support from prior highs around 270 as well as this trend line. So that'll be a good area to look at what should hopefully be the end of a drop if we did drop that far. I'm not expecting that, but that would be the spot to look at. As far as the ceiling, like I said before, 297. If we do break 297, we should challenge 302 in very short order. And then we'll see whether the Qs in particular are strong enough to push to new highs, but that would be the level to watch. So those are kind of the 3 points you want to watch right now: 284, 297, and possibly 270 something, but that's really not in the cards at the moment. All right, if we move on to the Dow, you can see again in the short term a little bit of strength, right? So some of these beaten up Dow names are picking up a little bit of strength, and stuff like Boeing, which has been just really hammered all year, you can see them. They're picking up strength even with today. Even if they faded most of the move, uh, money's flowing into these areas of the stock market because people are expecting a better recovery, and you know, with vaccines coming out hopefully in the very near future, stuff like this is going to start to perform better. Now, if you look at the weekly chart, you can see in the bigger scheme of things, this is still a stock that's struggling. This is still an area of the market that's struggling. So there is room for further recovery, but this also shows that despite the fact that these areas of the market are perking up a bit, and while the Dow Jones might look better than what we're seeing in some of these individual components, you know, we're not out of the woods yet as far as these beaten up names, and so performing better. And so, you know, there's still going to be a lot more time before I'm fully confident that stuff like airlines or casinos, cruise lines are, you know, going to be really ready to kind of catch up to where the overall market is, because, you know, none of those names are anywhere near all-time highs, and it's going to be years before they get back to that level. So even though we're seeing a rotation in the short term into those names, I think it's more a matter of them gaining some of that lost value, but their value is going to be depressed for a while, because even once we come back and when everyone's traveling at the same rate that we were last year, when everyone's, you know, gambling or going on cruises the same as before, these companies still have to deal with an entire year of lost revenue, right? And so it's going to take a while for their stocks to fully recover all the way back to recent highs. But what we're seeing right now, again, is they're getting a bounce because it looks like maybe the end is near as far as them losing revenue. And then they'll start to be able to rebuild their bank accounts and rebuild their, you know, rehire and just kind of get back to working in full force and operating in full force. But we're not there yet. And so I'm still hesitant to go ahead and trade those names too strongly. But like I said, we want to pay attention to where this money's rotating. And it's rotating to them at the moment. We'll see how long that recovery process lasts. Now, again, with the Dow Jones, in the excuse me, in the short term, positive. We're above or very close to above the candle from last Monday. You can see that actually on this Monday we did break above it. So, you know, the Dow Jones in the short term is recovering more quickly than the S&P 500 and the Nasdaq. In the long term, though, if I go back to the, actually, I'm not going to go to the weekly. We're just going to drag out. We're just now challenging the recent highs and all-time highs, right? So this is positive because we finally cleared new all-time highs on the Dow over the last couple of weeks. So we've got 3 indices now that are pretty close to all-time highs or have printed new all-time highs in the last couple of months, right? So overall, the market is still doing well. The market still wants to move forward, and generally speaking, is looking like it wants to move past the coronavirus and all of 2020 and just look forward to the next year and possibly more beneficial price action as we move forward. Now, we'll wait and see what happens at the turn of the year, but as far as going into the holidays, again, I like what I'm seeing, and I think this looks like a market that wants to rally over the next few weeks. Now, we're not fully there yet, but we're getting there. And again, we've got a trend line here. We know what we're working with. We know what we're trying to come up with, or we're trying to break out. Actually, I'll go ahead and put this at the wick. That gives us a better picture. So here's the same exact pattern that we saw in the SPY on the Dow, right? And of course, they're pretty closely related, so they're going to have similar price action. And we're looking at the same exact thing, so I'm not going to spend too much time on the Dow. We want to break above 300 in order to get to new all-time highs. If we lose this short-term trend and we weren't ready to push the new highs, we're going to come down and retest this 290 area. And if that falters and we lose that, well, we've got a gap here that needs to be filled around 285. And we've got this level around, again, this September 2nd, September 3rd price that's kind of critical to me, right around the 20 to 50-day moving average, which, in my opinion, is the floor that we need to worry about. If we lose that, that's when we worry about the market. As long as we're staying above that, I think we're good. So that's the support zone, somewhere in there between about 288 and about 280, or 281, that we need to concern ourselves with as far as the floor is concerned. And other than that, everything I said about the Nasdaq and the SPY, It's going to pertain to this as well. So really, nothing else to do here. I don't need to spend more time with that. Last one we want to look at is IWM, and this is the one that's kind of interesting because the small caps have been probably the area that's had the most trouble in this market. And while the rest of the indices were still kind of struggling prior to the election, IWM was already trying to break out and leading the way upwards. So we've got one of these rare moments in the recent past where the small caps are actually leading the price action upwards. That doesn't happen. It used to happen quite a bit, but over the last like 4 or 5 years or so, it really hasn't been the case. You know, in my mind, it's almost felt like the market and market participants have always had one foot ready to go out the door, and whenever there was any kind of selling pressure or correction in the market, the small caps would be the first to get hit because, you know, traditionally the small caps have the riskier assets and they're the more volatile assets. So when people are concerned with protecting themselves, this is the first place they leave. You know, what are you going to get out of first? Something that's really risky or something that's safe? And conversely, when people are looking at profits and are kind of being more aggressive, you know, you're looking at volatility because that's where you get more rewards. And so the fact that we're leading higher is a bullish sign that shows that traders are willing to accept risk and are willing to try to go ahead and take gambles in some of these names that are you know, a little bit more risky and also a little bit more beaten down. And so that's why we're seeing IWM kind of step up here, which again is a really good sign as far as showing that buyers are willing to accept risk and are willing to take gambles here. If we draw the same trend lines that we have on the SPY and the Dow Jones, you'll see that we actually have broken out already. Right? So we've broken out, showing that the bulls want to push forward. Now, whether this breakout holds or not, I think it's probably going to, you know, we'll see how we close out the rest of the week and whether this is something that needs to happen into the start of next week. But if we lose that, we've got support here at the 170 level, and then, you know, we've got plenty of room until we come all the way down to the 20 to 50 moving average. Now, again, if we look at that September 2nd, September 3rd price, where we had that kind of pivot in the markets, that's actually below the moving averages, and that's below a lot of price action. So showing again in the short term, IWM has really started to pick up some steam and started to move past what the other three indices are doing. So again, showing rotation into some of these riskier assets, and capital is kind of following into this. And so this is an area that we need to pay more attention to and take a look at some of these stocks that maybe aren't big tech names or big S&P 500 components, and maybe trade in, you know, the Russell 2000 as they've started to really benefit and move forward. Now again, in the long term, there's still work to be done. Actually, look at that. Did we clear it? We cleared everything. Well, that's a big move, yeah. I hadn't paid attention to that. We actually have already cleared that. All right, so we're in good shape here. So, once again, reiterating the fact that the market is trading at all-time highs or near all-time highs on all four of the indices now, and you know, everything is showing bullish signs. So, it's hard to get nervous about this. I feel like a lot of times when I look on Twitter or when I have people message me, they're nervous and they're wondering what's going to happen next. And you know, you have like last Monday's candle kind of scares people even off the gap up. But the truth is that we're in a good market. We're in a strong market. We're in a market that's trending upwards. Look at the moving averages. They've just been going upwards this whole time. And it's I know it's hard to believe that we just kind of brushed off an entire year of the coronavirus and have just kind of moved forward. But understand that, you know, the Fed keeps pumping liquidity into the market, and you might feel, well, that's kind of fake price action, but the truth is that if you own these stocks, you're getting paid in real dollars. And you know, in the long term, is there something that's going to happen? Maybe, but as long as the market and as long as our government wants to continue to prop up the markets, you need to take advantage of that, because if you just try to play it safe and put your money in the bank account, you're not getting you're not getting the same return that you'd get in trading stocks. Um, and so even if I know there's a lot of people that feel like the economy isn't in the same place that the market is, and that there's a disparity between the two. If you feel that way, that's fine, but you shouldn't let those biases and those feelings affect the way you trade the market and the way you try to manage it. Because in the end, you're punishing yourself and you're taxing yourself if you're not investing in the market and you're not taking advantage of this upwards momentum. The market's been returning 10 to 15% a year easily over the last decade. And if you just have your money in the bank account, even if it's a savings account, you're getting 1% or whatever it is, that's like a 9% tax that you're paying every year because you don't trust the market or because you don't believe in the market. Um, Now, is there risk involved? Of course there is. You're never going to get a return without a risk. But that's why we trade, and that's why we go ahead and analyze this every week, so that we're always on the pulse of the market, and we're always ready to anticipate when the market is ready to pull back, and that's when we go ahead and hedge ourselves or raise cash or take different types of trades or whatever it is to go ahead and manage your risk. But if you're not actively trading, if you're not taking advantage of this upwards momentum, then you're just taxing yourself for no reason, and then you're putting yourself in a hole because when the market conditions are poor, you're not going to get the same return, and you're not going to have the buffer of extra profits that you should have had by trading the market when it's doing as well as it has been for the last several years. So make sure that you're taking advantage of this while the market is actually delivering, because it's not always a good thing. And back in March, a lot of bank accounts or a lot of trading accounts had to get into forced margin calls and forced liquidation. And for those that didn't take advantage, and I guess the weekly chart will be easier for this. So for those that didn't take advantage and weren't holding stocks for and having their long-term accounts go up in value from 2015 to say 2020, when they had that drop, they had significant losses. And if you didn't have that buffer of all the profit that you made going up into that, you could have been wiped out. And you're going to have events where the market corrects, and they're going to be significant corrections, and they're going to shake out a lot of traders and a lot of investors, a lot of people with their retirement accounts. If you're not taking advantage of these long moves up to kind of raise your overall value in your portfolio, then these drops really hurt. So you want to make sure that you're taking advantage of when the market is giving you these gifts and is moving upwards, because eventually it does correct. And when it does correct, if you didn't have all that extra buffer and all that extra capital that you made from winning trades when the market was doing well, and you just trade when the market's in poor conditions, then you're in even more trouble. And like I said, if you just stay out of it, if you're like, well, I don't even want to trade in the market because it's a mess. Well, look at what you missed out on from all the way from 2007, 2008 when we had our last crash, 2009. Look at everything you missed out on because you didn't trust the market, or you don't think the market represents our economy. And if you just had your money in the bank account, you taxed yourself an unholy amount of extra money because you didn't want to trust the market, or you didn't want to get involved in it. So I know most of you guys aren't like that, but because obviously you're in here, you're watching a trading channel, so you're not going to, you obviously participate in the market, but just wanted to go ahead and point out that if you're not taking advantage of this momentum, you're in effect taxing yourself extra money. And until we see higher interest rates and we see an ability for capital to rotate back into something like real estate or in savings accounts or stuff like that, you're just going to be punished unfairly for not trying to participate in the market, which is where the government wants your money to be in. Butterface, we'll get to Amazon in a second, and we'll take a look at it. Thanks for asking for a stock. Anyone else in here, if you guys have a stock you want me to look at, feel free to type it into the chat, and we'll get into them in a second. So let's take a quick look at the U.S. dollar. We'll look at oil, gold, and silver. You can see the dollar is range-bound, but struggling, and it's right back at the bottom of that range. When we look at the euro chart in a second, we'll see the inverse of this, and we'll see that the euro is pretty close to the top of its range. And so, the dollar, it's trying to stabilize here. And again, this is in effect what's happening with the stock market, right? The market is doing well, and part of that is because we keep trying to inject liquidity into it. Sorry. So here's the euro. We're going to see the opposite now. The euro had a really nice run versus the U.S. dollar. And this is interesting because it's been a reversal from what it was doing prior to that. It actually was struggling quite a bit versus the U.S. dollar over the last couple of years. And as we headed into 2020, it started to finally bounce and stabilize, and then finally has picked up some steam and moved upwards. Now, there is more room for the euro to climb before it gets to real major resistance levels. So there is room for this to continue and for the U.S. dollar to drop even further. So keep that in mind. If you look at the daily chart, you feel like, well, this is pretty high up, and this is an area that it looks like it could top out. But it is in the process of consolidating, and at the moment there is potential for it to break down or break out. But keep in mind, don't think just because it looks like this is a top that there isn't room to the upside. There is room to the upside here if the dollar loses more value for the euro to gain value. So keep that in mind. And until it breaks out of that range, I mean, at the moment we can assume that this is the top. And you know, it's kind of one of these deals where when a stock or an equity is range bound, treat the ceiling as a ceiling until it breaks through it, right? So for the moment, we can assume this is probably the spot where the dollar wants to bounce again and where the euro needs to kind of pull back. But keep an eye out. If it does break this ceiling, it can start to move upwards pretty quickly. If we look at the U.S. Canadian, again, we'll see the dollar is pretty close to support, struggling quite a bit again, and has really struggled to kind of stabilize here. Each time it's come up into the 133, 134 range, it's been shot down pretty quick. However, it is right around support, or it's getting close to support. So just like the picture with the euro, despite the fact that we're here at lows, there is potential for a lower move, but until we see an actual breakdown occurring, we can assume that there's probably going to be some support here, and we can look for reversal candles. But as you can see, each subsequent bounce has gotten weaker, so it looks like the dollar is again struggling to maintain this level, and if it continues to show signs of a breakdown, there's a decent chance we head even lower. And the last one we want to look at is the US yen, and same picture. Dollar near lows, struggling. It did find a quick reversal off of a breakdown. So we had a false breakdown here, which normally is a sign of an impending or coming long rally or rally. That didn't happen. It got rejected again pretty quickly at this intermediate term trend line at the moving averages, and it's heading right back down below support. So again, the dollar is not looking good right now. It is at support for the most part, so there's always a chance that it finds some stability and bounces, but it's not looking good. This should bode well for gold and silver. We're not seeing it yet, but if the dollar breaks down, we should see some relief in gold and silver. We should see them bounce. I am not excited about this still. It's actually kind of stuck here between two kind of important levels, right? We've got this support that developed after it broke down, but we've got this ceiling here that it's really struggling to clear around the 180 on GLD, and it's below the moving averages. So we need to see a dollar breakdown before we're really going to see any kind of upward momentum on gold and silver. Now, like I said, GLD is holding. It is finding a floor, so there is a chance that we could buy this, knowing that we're going to have to navigate through this area here and possibly take partial profits or do something to kind of mitigate the extra risk that's in a reversal coming up at that level again. But at the moment, we're really just waiting for further dollar weakness. You can see that this, SLV a little bit better because it's already trying to break through the moving averages. It's already trying to break back above this floor. So this might be a better spot if you're a bear on the U.S. dollar, if you're bullish on precious metals. Maybe SLV a little bit better of a spot here, or maybe look at miners that are more related to silver than gold. And then finally we have oil. So here's a look at the oil chart, and it's just stuck. It's stuck in neutral. We have a range that's pretty clearly defined, and we've been talking about this range over the last few months now. It's not ready to break 43, and this 34, 35 range is a good floor. And I think that's fine. I mentioned this not last week, but the week before. We didn't meet last week, but a couple weeks ago I mentioned this. We don't really want oil above this 45 right now because I don't know that our economy is ready to be able to sustain high energy prices. But at the same time, we don't really want oil to drop below 34 because that's a sign that our economy is shrinking and that we're not consuming as much energy as we've begun to consume now that we've been recovering a bit more from the coronavirus shutdown that we had earlier in the year. So we're kind of stuck here, right? We don't really want oil above or below this range, and it's kind of in the middle, and it just keeps hovering back and forth between the two. I think this is one of those areas where if you're trading energy names, range-based trading styles like selling calls, iron condors, calendar spreads, that sort of stuff is probably returning pretty well as far as energy is concerned. And until we see a shift in that, that's kind of what we can expect. Now, this is a little bullish, what we're seeing right now. It looks like it wants to challenge and break out of that range soon. And we'll see what happens as we head into the colder winter months as to whether we get enough energy demand to break out and start to forge into the mid 45 to 50 range. But for now, this is what it is. It's range bound, and I haven't really focused too much on energy names or gold and silver because the tech trade has been kind of the area that's been a good focus this year. And for the moment, I'm just watching this in a range, but not really doing much with it. All right, so that's the markets. That's oil, gold, silver, the U.S. dollar, the whole thing. Big picture, like I said, is we have a market that's more bullish than I think people are anticipating. And really, it's a rotation game that we need to concern ourselves with right now and try to figure out what areas of the market are behaving better than others and what we can go ahead and filter our capital into as we try to trade in the next few weeks. So, Butterface, you want to look at Amazon. That's interesting. It's a good segue into looking at this, considering we were just talking about some of these tech names. And so here's the interesting thing. Amazon's one of these names that has benefited all year. Right? Because people have to shop, and so they're doing a lot of their shopping from home. And as you can see, it's had a very strong year. If you look at the March coronavirus drop, and you see what it's done since then, it's had a massive, massive year compared to what the stock market has done, compared to what other names have done. So it's been very strong. Now, in the more recent term, it's not struggling, but it has slowed down. And like I said, particularly in the recent past, a lot of this is because these names are starting to get, I don't want to say punished, but money's rotating out of them because they suspect that their business is going to slow down now that people can go back out and shop in person or whatever. I don't think that's really anything to concern myself with. I think Amazon is such a strong stock. This is the one name, and I don't know if you're asking about this because as a short-term trade or a long-term trade, but just to kind of shift gears a little bit for a second, as far as long-term names go, whenever anyone asks me, oh, what's a good stock to buy, or what's what account, what would you start your account with? Amazon to me is one of the best stocks you could possibly own if you're someone that just wants to, starting a Robinhood account. Or if you want to add to your retirement account or whatever it is. I think Amazon's one of the best names. I think this is a trend that's been in place for many years now, and I don't see this changing. Amazon has expanded their own delivery now, and in all honesty, they're taking over commerce to a level that it's putting a lot of brick and mortar retail into serious jeopardy. And I don't really see that changing. So I think Amazon's one of these stocks that everyone should own and everyone should confidently buy whenever there's a stronger correction in it. Now that being said, we saw the price action that it's had all year, right? And you see the price action, and we look at the weekly chart. So one thing I will say is when you buy stocks long term, you want to buy them at value. It's very different from swing trading. I think swing trading, you want to buy strength, particularly short-term strength. But with long-term buying, you want to buy weakness, because you want to buy it at discount, because you're going to hold it over years. You don't want to buy it at the top and then have it kind of fluctuate back and forth while you're waiting for it to regain momentum. So if we're looking at it long term, and so you're saying you're asking about this from a long term perspective. Long term, we don't really have an opportunity to get too much of it now. For someone that doesn't have any of it, it's not going to come back to this level. 1600, 1700. For it to get back to these levels, we're going to have another crash on the level of the coronavirus or the 2007-2008 bank crisis before this thing is ready to correct to that level. At least in the next few years. Who knows what happens with the market? At some point, the market will likely tank. But this is not a name that's going to tank on its own. It's just too strong of a name. Now, granted, all names they all have cyclical weakness, and it will drop at some point. But this is the kind of name, like I said, I trust more than most of the market. And so, when I'm looking at it in the short to intermediate term, this is the level. This is the next floor, right? And as you can see, we've got our own ascending trend line here that's kind of mimicking what the market's doing, but weaker. And so this is the first level for anyone that doesn't own any and decides they want to kind of start building a position in Amazon in the short term. And in reality, for now, for swing trading purposes, this is a good level as well. So whether you're looking at this as a long-term chart or as a short-term swing trading chart, there is potential for an entry here at 2,900. I wouldn't, let's say in the end you want to put, $5,000 or $10,000 into this. I wouldn't put it all here. I would maybe put $1,000 or $500 and slowly build up as time goes on, because there are going to be times when this thing drops and there'll be times when it goes up, but you don't want to buy as much as you can now and then it drops into the 200-day moving average, or for whatever reason we get a stronger correction and it has to come back down into some of these areas around 2,500. So when you're trading long term, you never want to just buy it all out. You want to scale in. And so there is an initial scale in there at 2,900, because again, it's such a strong stock. There's always a chance that it doesn't really drop below that. However, so for those of you that maybe follow me more consistently, you know that back in March, I actually did quite a bit of repositioning of my portfolio. And I made a big reallocation of a lot of, I kind of abandoned a lot of stocks like gas companies and oil names and stuff like that, and rotated into stuff more Amazon, more Netflix, stuff like Zoom, stuff like like T-Doc or Docu, which that's a discussion for another day. But back in March, I scaled into a lot more Amazon, and since then it's gone straight up for me. Obviously, that's a perfect timing for that. But you don't always get those perfect additions, right? And so if you didn't get that and you felt like you were chasing it upwards, you missed out on other opportunities. You missed out here in the 2,200. You missed out again here maybe at 26. And so there have been now 2 or 3 bounces here in the $2,900 range. And there's a chance that this holds again. And if it does hold, it's going to be another good entry for people. And the truth is, it may not even get to that. Because again, the market is actually starting to rally right now. And even though these tech names are struggling at the moment, they will recover. And Amazon, heading into the holidays, is likely going to recover because, again, there's still going to be a lot of shopping done through Amazon. So, long term, 2,900, and then the 2,700 at where the 200-day moving averages, and then possibly down around 24 are 3 levels you would look at to scale in. Short to intermediate term, again, this 2,900 is a good floor. However, there's always a chance that we respect this trend line, and if we get back above this moving average, we've got a nice little spot here. So there's actually a swing trade to be had here as well. For those that are looking at this differently, if tech is going to recover, and again, rotation, when we have a shift in the market like we're seeing right now, where money's starting to rotate into IWM and into the small caps, it doesn't happen in one shot. It's a pattern that's been happening now for about a month. And what ends up happening is you get some money rotating into it, but then you get the fluctuation where these tech names need to rebound. And so they'll rebound, money will flow into them and out of the small caps for a few days, and then back and forth like a little seesaw. So there is a chance the money flows back into Facebook, Amazon, Netflix, all of these, and we get a break of these moving averages and we get a bounce. And if that's the case, there's a swing trade to be had here for those that are watching this. So keep an eye on that for those that are maybe shorter term and looking for some kind of a move through this and back up into this 3,300 range and possibly even back into recent highs. Because again, if the market is going to rally into the holidays, I find it very, very unlikely that the small caps don't participate, or sorry, that the tech names don't participate. And if they do participate, as you can see, there is room, there's plenty of upside, and there's room for them to bounce and to move upwards. So even though our discussion in a second is going to be on names, some small cap areas that I think are rebounding nicely, don't necessarily sleep on stuff like Amazon or Apple as we head into the holidays, because there is definitely room for them to bounce, despite the fact that we're seeing money rotate into small caps and out of these names. It's only going to do so much before money comes back into them. These are the most widely traded stocks. They're some of the strongest stocks, and there's no reason not to think they're not going to bounce if the market bounces. So keep that in mind too, guys. Don't necessarily, don't abandon these names. And so some of the other ones, like I said, that were strong tech names that I thought were going to do good this year. So, stuff like Zoom. Again, you can see Zoom stalling out, getting punished a bit. DocuSign is another one. And again, you can see a lot of these names are trading at lows, right? And so this idea that these names all of a sudden are going to lose their profitability, I think is a little kind of far-sighted or short-sighted. And the truth is, these names are still going to be part of a growing shift in the way we go ahead and go to the, for instance, go to the doctor or shop or do our, signed documents online. Like these are names that are still part of a trend that's going to continue growing and shifting as far as the way we go ahead and operate. So long term, I still think these are good names. In the short term, they're stalling out because the market thinks, well, we don't need them anymore. But that's not going to be the case, and I think they're all going to benefit. But as you can see, a lot of these names are the stocks that did well all year, but they're kind of struggling in the short term. And I think if the market rallies, these names will bounce with them. But, for now, those are the names that, as you can see, they're starting to struggle a bit. But when you look at the bigger picture, they've had massive years because, again, they've benefited tremendously from the way we've responded to the coronavirus. Mr. Shiitake, I am not. Butterface is, and I guess you are as well. You got EU on your name. I am actually from Miami, Florida, in the U.S. All right, so looking at small caps, instead of trading stuff like American Airlines or Boeing, last week in my post when we were discussing how do you trade a market and the way it's been going and when money's rotating into different areas, and I was looking at some of these beat up areas, right? And so when you look at stuff like American Airlines, you look at Boeing, right? Or you look at, say, AMC Theaters, which again, theaters are another area that's getting just destroyed, or cruise lines. I'm not that excited really about trading these yet, right? So what I like to do in these scenarios and what we discussed last week is my focus is what other beat up area has been recovering a little bit better and can actually maybe you can have a little bit more confidence in them recovering once things open up. Okay, so you're from the UK. You're getting into stocks and you wanted to ask where you can get info on companies before it hits the market. You mean like IPOs and stuff? And while I wait for your response, I'm going to continue on the thought process I had before. So rather than looking at stuff like Carnival, what I recommended on my post on Patreon last Monday was let's look at restaurant names, right? Because those guys are in the same boat where people have been maybe not going to restaurants, but I have a lot more confidence that we're going to return to restaurants who are already kind of benefiting from maybe takeout rather than airlines and cruise lines, which could still struggle from even once we open up from traders being or from you know travelers being more scared to use them. I think people will be a little bit more quick to go back to restaurants, and so some of my trade recommendations last Monday were these restaurant stocks that have been beat up and have finally started to gain some momentum. And as you can see, so Ruth Chris was one of the ones we were looking at. You can see it had a nice bounce, and like IWM, is starting to pick up some steam and trade a little bit better. Stuff like Dave and Buster's, which I think is a little bit more of one of these names that might take a while to have people get confidence in them. But again, you can see the bounce. Starbucks is another one we looked at, and you can see that they've started to pick up some steam. So I feel like rather than take my gamble on cruise lines and airlines, if I'm looking at these beat up names and I'm looking at this rotation out of money away from IWM and or into IWM and into small caps or into beat up names, I think I'm focusing on this rather than focusing on, say, Boeing or American Airlines or Carnival Cruise Lines. Another place you could look at is maybe Realty. You have a lot of REITs have started to pick up some steam and have started to bounce a little bit.